Afternoon, folks. It's Dave Burrows. I'm CIO and chairman here at Barometer Capital Management. I want to thank everybody for joining. It's surprising to see a bunch of people on here in the middle of August 20th. We're in the sort of the quietest period of the year, although last couple of weeks doesn't feel so quiet. So, lots to talk about. It's an interesting time, one of those times when I think we really have to distinguish between staring at the data as it is today versus the liquidity in the market and the liquidity to come and what the market may or may not be discounting. Definitely an interesting market and one that's a little different than a typical August. Lots to think about. So just as starting from top down, we think that we've been in a structural bull market since 2013 in US stocks. Other markets have joined along the way. Certainly, there have been lots of ups and downs along the way. Last two structural bull markets have been able to consistently stay above the rising 200-week moving average. And the most recent bear market was no different, stretched from December of 2021 through January of 24. And here we are now 8 months beyond there, and the market has been marching its way higher. Not without little wobbles, but in general, pretty low volatility, which is, to make a point, not uncharacteristic for what happens after cyclical bear markets. And you tend to get a pretty steady march higher. There tends to be lots of things to worry about. There tends to be lots of things that might keep people on the sidelines. And generally, it's not till the end of a cyclical bear market where everybody decides that they need to be fully invested. So our comment coming out in January was, October of 22 was the structural low. And you can see that actually back here at the end of 2022. Market started to broaden in March of 2023. So that's 16, 17 months ago. That's a date that we like to use to look at kind of what's been going on in portfolios since then, because we had lots of different things contributing. You can see all of the moving averages slowly turned higher. And as we sit today, we hit a high in the middle of July. We had about a 10% pullback, 9.5%. Markets bounced nicely, not back up into the channel at this point. But certainly we've had a sharp move higher. And that's been concerning for a lot of folks because, that move down shook out a lot of people. Once again, we sort of held at the rising 200-day moving average, but it wasn't without consequence. For some of the rule-following quantitative funds, and they're big, they were forced to take their exposure down quite dramatically. Diana, you were on last week to talk a little bit about, some of the selling that took place into an illiquid market. And the impact on the market, but you gave us these charts, what the CTAs had done with their exposure, what long short managers had done with their exposure. And we talked a little bit about volatility. And I think it's really interesting to look at. Now, we've said over these webcasts that during a cyclical bull market, you tend to have periods, extended periods of relatively low volatility. And we've been in this lower volatility range through the course of this year, but of course, early this month, we had this giant spike. Now, to put it in context, this spike rivals what we saw at the beginning of COVID. It's a bigger spike than what we saw in the rates taper tantrum at the end of 2018. And, really not that far off from what we saw in the financial crisis in 2008. Now, the difference is that in each of these other cases, it took months and months and months before volatility came down into the lower range. Certainly the financial crisis took a very long time. It did in 2011 and 12. But this time, volatility has come right back into the middle of the range, sitting here at 15, which is typical for a structural cyclical bull market. So, Dan, I thought maybe we could talk a little bit about liquidity just as a follow-on from last week, because, of course, what's good for the goose is good for the gander. And we got the volatility come in. What did that mean for the quantitative funds? Oh, I can't hear you. I think you might be muted.
I'm sorry, can you hear me?
Yeah, I got you.
Okay, all right. Sorry about that. These quantitative funds have sold, according to Goldman Sachs calculations, $160 billion over the last month. Those are big numbers, and honestly, this is the biggest deleveraging and the fastest deleveraging I have seen in my career. These funds seem to have A, become bigger, but B, are trading right now in a very illiquid environment. In Europe, for example, and they're selling globally and they're buying globally. And European volumes right now are down 50 to 70% in some cases, and US is down about 20-25. So they're coming to do these mandated things. This is their mandate. When the volatility spikes, they have to take their exposures down. When volatility spikes, they have to take their leverage down, exposures. There is no judgment or decision. So they just go. So they sold $160 billion. But volatility, you talked about the VIX prior to this. VIX has gone down so fast. It's down about 62% in 9 days. So we've gone from 65, from 13 to 65 and back to 15 in a matter of what, 2 weeks. So now it's funny, but they have to buy. And just like the calculated amounts that were sold are calculated based on the AUM, the assets under management that these prime brokers know they have because they prime with them, they also can calculate the upside. So the interesting thing is that over the next week, the calculation is that they have to buy no matter what the market does. So if the market is flat, they have to buy $85 billion globally, about 30 in the US. If the market's up, they have to buy about $90 billion. But if the market is down, they have to buy $62 billion. It would follow they would sell. But no, we've come back into levels of market that small moves mean that they have to re-engage. And also the volatility in the form of VIX is at 15. So they have to re-engage. So if the market even is down, we're not talking about majorly down, just normal down in a normal end of August, quiet, sleepy period, could be down like we were today, 19 beeps, they still have to buy. Over the next month, same situation, lots to buy. The highest amount that's calculated is about 130 billion if the market's up, but if it's flat, about 100 billion. And if the market is down over the next month, they have some stock for sale, but not that much, only about 60. So when you think about the fact that they delevered 160 billion over the last month and about 300 billion over the last month and a half, selling 62 billion or 65 billion, it's really not that much if the market goes down. So there is some support. I want to mention one other thing. The buyback number for this year is $960 billion. So the amount of calculated stock buybacks that corporates are doing in the market, and it's been a theme and it's been a support, it's $960 billion.
So to be clear, Diana, that's commitments that corporations have made in their documentation to buy back their own shares. This is outside of what we've just been talking about. This is corporations, which are the biggest buyers of equities, using cash to buy back their own shares because they think that they're getting good value.
Yeah. So $960 billion is the annual number. Now, between now and the end of the year, they buy about 42% of their buyback because they spread it over the year. But for this August to September and October, November, December, it's 20, between now and September, it's about 20%, and then the other 22% between November and December. That calculates to about $8.5 billion of demand daily from the corporates. So I don't remember a time when flows have been so impactful. A, they've gotten larger, and B, we really are in an illiquid environment, but they have gotten larger.
Right.
These quantitative funds come out of the great financial crisis. A lot of pension clients have bought them. This is given by the pension funds. these low vol, half vol type of funds, and they've grown since then. So the assets under management have grown, and so their impact has grown.
Yeah, it's interesting. I mean, this is why in a cyclical bull market we tend to have lower volatility, but it's being accentuated. Okay, so you have these quantitative funds needing to be buyers. You have corporations buying back their own shares, which of course they've just come out of the quiet period because during earnings, they largely aren't executing. There's something like just over $7.3 trillion sitting in money market funds, and some of it likely to stay there, but certainly some of it likely to get put to work in equities through the course of a cycle. And of course, we're just about to start seeing the Fed start to ease. We are seeing other central banks like Canada already have started to ease. So you have an easing cycle. You have natural long-only buyers, fund managers that are long most of the time. All of this happening in a time when there's not a lot of built-in selling. So it's why, despite the fact you get the odd wobbly economic number, the market seems to be on a pretty good footing. And we see it in from a breadth perspective. And Diana, I put this slide up on the screen a couple of weeks ago. This is maybe 4 weeks. And we were looking at the percentage of stocks that have outperformed the S&P over the course of the year. And what's interesting is that this last 30-day period, whereas up to beginning of summer, 25% of stocks were outperforming, 63% of the S&P is now outperforming the index in the last month. So that's a change in character. And I think one of the things that stood out to me is when I look at the equally weighted S&P, we basically have traded back to the highs, where the S&P and the NASDAQ are still considerably off the highs from this little pullback. And I think that that's actually really interesting because it talks to the fact that more stocks seem to be participating. This was a stat that I saw yesterday I thought was quite interesting. And it looked at the number of companies hitting 52-week lows and 52-week highs, and you had this giant spike in volatility. This is how many companies hit 52-week lows. This is what happened in 2020 when we got the 2020 spike. I mean, these are very different pictures than what we're seeing. So it just speaks to the nature of sort of the technical impact of that selling that took place in Japan, and probably it's more of a technical event than anything else. And in fact, the breadth, appears to be getting a little bit better. Thanks very much, Diana, for jumping on. Just to carry on, I think it's also pretty interesting to see what's happening in the U.S. dollar, only because of what happens when the U.S. dollar goes up. U.S. dollar rallied all the way through the 2022 sell-off in stocks. This is a flight to safety. And it peaked. This is the US dollar versus the pound, the euro, the yen, Canadian dollar, and a couple of other currencies. When it peaked at an overbought level, that was the low for equities. We had a sell-off into March of 23, and relative strength peaked, rolled over, stocks rallied. We had a sell-off into October of last year, a typical fall sell-off. US dollar peaked. Market rallied through there. We had a little pullback in April, a little pullback in June. Look at this US dollar now. I think this is really relevant. So June through July, we've broken all of the support in the US dollar. The Japanese yen is rallying. The euro is rallying. The pound is rallying. The Australian dollar is rallying. Even the Canadian dollar is rallying against, a very unfavorable political situation. And that has implications for a lot of things. It has implications for commodities. It has implications for global stocks. When the US dollar is weakening, global investors are less prone to focus entirely in the US. Now, this is the Japanese stock market, and this is the bear market it went through for 30 years from 1991 through 2023. This was the sharp sell-off we saw 2 weeks ago. Look, we're right back up into the top end of the range. So the selling took place in the night because the yen had rallied and it forced some covering. But look, stocks rallied right back. Warren Buffett turns out to be pretty smart to do a $500 million bond deal the day the market sold off to buy Japanese stocks. he's probably up 10% on that to start with. India continues to behave very constructively. Even the TSX made a new all-time high this past week, again, versus US, which is not back to the highs. So global stocks we've talked a little bit about as being an attractive option. Global stocks ex North America. The way that we've structured our fund is that it's meant to be structured along index lines because we like the sector makeup of the global universe, MSCI ex US. But 50% of the holdings, 40 companies, are high relative strength leaders, and 40 companies, 50% of the portfolio, are value companies that are showing signs of change. And then we rebalance that on a quarterly basis. So this is meant to be quite a systematic approach, and is meant to give us a smart index rather than just a market cap weighted index. Just on fixed income, we saw generational low in rates in 2020, much like we did in the late 1940s. We've had a sharp move higher in yields, not very friendly for bond investors. That hasn't changed at this point, although I will highlight we've had a lower high. We dipped briefly below this previous low. We're back above it right now. But very clearly, there's a shift taking place. These moving averages are changing. And we believe probably we're into a longer period of bond underperformance. The TLT, the 20-year bond, sold off 53% at the low point in the fall of last year. It's rallied a little since then. It's captured back maybe 15% of what it's given up, which I think is probably not very comfortable. This has been the longest drawdown in the bond market going back over the course of period when rates were falling. So it's a change in character. The way we look at it is with rates coming down, other things may do better. So certainly since the rates bottom, stocks versus bond stocks have clearly outperformed and continue to. When we look at income investing through dividend growth as opposed to the aggregate bond index, dividend growth has been steadily outperforming and actually didn't even underperform going through the bear market. So our view is that in a rising rate environment, we're better to have a rising stream of income. And so rates topped out in October of last year. So we're coming up on a year. The aggregate bond index since then is up 7%. The S&P is up 29%, so equities certainly have done well. The dividend growth ETF RDVY up 26%, which is similar to what's been going on in our income fund. Dividend growth is clearly a bigger beneficiary than straight fixed income. And the goal here is to make sure that we own things that are good getting better and that are going to give us some advantage over some broad-based ETF. So I just thought I wanted to put a point on that. This is a chart that highlights the periods where rates were rising versus periods where rates were falling. And from 1980 on, you can see largely rates were falling with bouts of increased rates. Now this one actually ends in 2023. If we were to program it out to today, you can add another third to this blue bar. That's a change. And that's a lot like what happened through the 60s and the 70s and into the early 80s, long periods of rising rates. And when we look at what happened in that period, this is sort of 1950 on through that period of rising rates, dividend growth was by far the best strategy. Companies that had an ability to generate a lot of extra cash and didn't need financing paid it out to their stakeholders. And we're seeing that in dividend growth today. In our income strategy, when we take all the periods of rising interest rates since we began managing it and look at the returns, fixed income through each of those periods went down, but the returns in the tactical income portfolio went up, largely because we focused on dividend growers. And certainly that has been the case over the last 4 years. Tough time for bond investors, great time for dividend growth investors. So that portfolio tends to have a lower valuation than the market. It tends to have a higher dividend growth rate than the index over 3 years and 5 years, and tends to be more of a value-oriented portfolio. Moving on, commodities, continue their little consolidation. We've seen this series of higher lows and higher highs. This is October of 2020. This is the global tightening cycle. We saw a series of higher lows. It's interesting to me that in the last 2 months, prices backed off a little, not all that much, but on some of the weaker economic data. Hedge funds, I think, used this as something to bet against in case that we got into a harder landing situation. Crude has stayed within the range that it was in. Certainly gold is absolutely blasted off. In fact, if you compare it to what happened out of the last long saucer shaped bear market that ended in 2005, gold went up 350%. We're up about 19% so far out of this cycle. So probably pretty early in the process. Central banks certainly are big buyers of gold. And interestingly, when we look at gold and gold miners as a percent of global assets, at turning points historically, by the end of cycles, it wound up being pretty significant holding, not a very significant holding today. So lots of room for buying. And then we talked last week about copper having found some support here at the moving average. And, that appears to be the case. We're moving higher up off it. So come out of this tightening cycle and moving higher. So I think in general, commodities continue to look pretty constructive. This is the more near-term picture for copper. Not that much of a pullback, frankly, going through the period. And this is a relationship we want to keep in mind because I think it might have some implications. This is gold versus the NASDAQ from 2000 through 2011. So it broke down in 2010 and retested from the other side. And then on a relative basis, underperformed from 2011 through until 2021, where it made a low, traded up through the long downtrend versus the NASDAQ, retested from the top side, it's made a lower high. My guess is we're seeing a shift in the balance of power here. Certainly NASDAQ's well owned, gold's not well owned. I think there's an opportunity here. But hedge funds have been making a bet against commodities, which is interesting because even despite that pullback last 2 weeks, the number of analysts looking for a hard landing is about the same. The number of analysts looking for a soft landing in the economy has expanded. And so actually, we're in the camp where we think that we see a soft landing. And that means we don't see a lot of demand destruction. Earnings came in as expected, up 9% on the quarter after a series of quarters that were weak from an earnings perspective. But what's interesting is that expectations for margins continue to go higher. So the other thing that's interesting is that this past quarter was the first quarter where not only the Magnificent Seven had good earnings, but we started to see improving earnings out of the rest of the market. We think that happens going forward. So what does that all mean for the portfolios? We don't have to be everywhere. Our job really is to identify the areas of the market that are set up fundamentally and technically to show leadership, to be revalued versus the rest of the market. Areas of the market that have a tailwind. We're always looking for change, new leadership to emerge or old leadership to recede so we can make sure the portfolios stay relevant. And in the absence of leadership, we got a willingness to sit on cash. So this is quite a tactical approach. It's meant to be a complement to other strategies that people may use to be fully invested all the time. This is a little bit more tactical. We use a combination of top-down tools to try to identify the neighborhoods we want to focus in, sectors within asset classes that show a tailwind, and then find securities within those groups that meet our business tests to use to build the portfolios. So the idea is build a portfolio of securities with parts of the market that people care about. And that changes over time. When I say people care about them, I want to see sectors where over time, a higher and higher percent of securities are participating in the rally. So if we take the NYSE, we want to see over time more and more stocks participating, not just a few. So the fact that early in the summer, only 24% of companies were exceeding the return of the index, and in the last 30 days, over 60% of companies are exceeding the index, it tells us we're seeing some broadening in the market. We want to be focused in those areas. What we want to avoid are parts of the market where we're seeing deterioration in breadth. If the leaders are carrying on, but the weaklings are selling off, that tells us there's not enough new buying, or there's enough new selling coming into the market where the risk reward in that neighborhood's changing. Okay, so last week we highlighted that after the sell-off a couple of weeks ago, we had some of our short-term indicators turn back up. Here's what things look like this week. Bullish percent, or the percent of stocks in uptrends in Canada, has reversed up. The percent of stocks in uptrends globally has reversed up. The percent of stocks in uptrends in the US has not. However, around the world, the percentage of stocks trading above their 50-day moving averages has started to show a nice expansion. The percentage of stocks in the NYSE with positive weekly price momentum had a great pickup this week. The percent of stocks making new highs versus new lows showed improvement, and the percent of stocks trading above their 150-day or 30-week moving average traded back up through 50%. So what we can see is a lot of stocks trading above their short-term trends, about half the stocks trading above long-term trend. It's improving sort of all the way around. That tells us that money is getting put to work, not just this quantitative money. Okay, let's talk leadership themes. What's changing, what's not? Well, I put up this morning on Twitter this chart. And I put it up specifically because when the market sold off, I said, it will be interesting over the weekend to see what has held up better than the market. And then when the market rallies, what is it that bounces back to new highs quickly? That's a sign of leadership. A leadership theme or stock should be like a cork. You pull it down underneath the water, and the moment you let it go, it pops back up to the surface. That means there's underlying strength. You can see that this month there was a sell-off, this thin line, back to basically the low from last month. It was about 4%. S&P sold off 10. And very quickly, the XLF has popped right back to new highs. I think that's really important. The financials sector is a really important sector in the market. It's a sector that we've highlighted went through a long bear market, became underowned and unloved, broke out, went through a financial tightening cycle, and over the last number of months has been marching higher. I've said that during a period of falling rates from 81 to 2020, you had 40 years where the borrower was in control. And we think since 2020, we've embarked on a period where the lender's in control, where the lender has an opportunity to set price. And of course, banks and insurance companies fit into that. Progressive is one of our largest insurance company holdings. It's in our top 5 holdings in the firm. It's trading better than 93% of stocks in the S&P. The relative strength is working its way higher. Look, this was the dip, and we've gone on to make new highs. JP Morgan is very similar. It went through a dip and very quickly came right back to the surface. So this is a sign of market leadership. I think these two companies, really are set up well. Fairfax is another, and Royal Bank here in Canada fits the same bill. Industrials. Industrials are a sector that are highly economically sensitive. Industrials bottomed when inflation started to pick up. Through the bear market in 2022, made a low prior to the market making its final low, and didn't make a new low when the market did in October. That was the first sign. It eventually came out of this sideways period in 2023, traded higher, really didn't give much back through the tightening. And here we are very quickly right back up into new highs. Now, in this group, of course, we have defense, and defense, for obvious reasons, is behaving quite well. We own General Dynamics and Howmet Aerospace. But again, look at the resilience here, trading better than 96% of stocks. And the other group that's interesting are the waste management, or as they call them, environmental companies. Now, pollution management is one way to call it, is highly economically sensitive. Their volumes are completely determined by the economy. And what I think is interesting is both Waste Connections, which we own, and GFL Environmental are making new highs. If you're looking for a rapid slowdown in the economy, these stocks should be getting hit, and they're just not. So I think that that's a real positive canary in the coal mine. Material sector pulled back a little off of the highs, not too far from the highs. The strong group in here are the gold stocks. These companies have been through a lot of consolidation through the course of a bear market. The ones that are still standing are operationally sound. We own companies that have multiple assets, so multiple mines in multiple jurisdictions. We've tried to stay in safe jurisdictions. We think Agnico Eagle is probably the most apt to be held by institutions. That pays a 2% dividend. They've been growing their dividend over 20% a year over the last 3 years. And look how quickly it's gone to new highs. So this is a sector we think is really under-owned. It's very unloved. We also own Alamos Gold, which I started talking about maybe a year ago. Alamos is an $11 billion company with assets in Canada and Mexico. Again, look at the relative price behavior since February. It's been really quite remarkable. So this group, I think, is in the early stages of a bull market. Certainly one that we want to keep a close eye on. Energy's consolidated. It's sort of in the range. Interesting to see that the Canadian energy companies have behaved a lot better than US energy companies. A lot of the Canadian companies have long life assets like, say, Imperial Oil or Suncor or CNQ, as opposed to the frackers in the US that have to continually frack and find more oil in the shale. Certainly, the pipelines moving heavy oil into the US, into the coast, are showing some improvement in volumes. And so this is helping our companies. But these companies in general are generating really nice dividends, really nice cash flows, and actively buying back their shares. Pharma. So pharma in general has not behaved all that well over the last couple of years, but certainly is perking up. And on the back of that, we're seeing strength in a couple of the stars. Lilly is a company that we've been in now for about 18 months. And as you know, they are the leader in the GLP-1 weight loss drugs. They have getting applications to treat all kinds of different issues. We know that when people lose weight, sure, it makes them look better, but their kidneys perform a little bit better, their livers perform a little bit better, they have less chance of getting diabetes. And so as a result, some of the payers are agreeing to pay for this drug. And we think that there's a long runway of growth in front of it. Novartis is really number 2 or number 1 in oncology. They've been making great strides, and you can see, the relative price behavior here performing well. Again, 2.7% dividend yield, growing at 7-8% a year. The dividend growers continuing to act well. In the consumer, really, we're just focusing in the cost-conscious consumer. Costco is a large holding. Dollarama is a large holding. We were in Amazon. I mentioned last week we got stopped out. We're going to have to take a hard look at Alimentation Couche-Tard, who are bidding, it appears, for 7-Eleven. If they win that, it could open some real runway for them for earnings growth. But we don't know any details yet on that deal, so stay tuned. In the defensive groups, over the last couple of months, defensive stocks have acted a little bit better. We've talked about utilities now over the last 6 months. This is the XLU ETF. 2 biggest holdings here, Nexterra and Southern Company. These we both own. That makes up 20% of this ETF. They're the 2 largest utilities in the US. I will highlight that as the market has rallied over the last couple of weeks, the relative price performance for utilities has been weaker, as has been the relative strength for REITs, but they are making new highs and they do pay us nice yields. So they're in the portfolio, but they're going to have to prove that they should stay there. We do own the residential REIT, REZ. So this is the one area that is ambiguous. This is the tech sector, XLK. It's made up of the very largest of large cap tech stocks. Microsoft makes 22% of the portfolio, NVIDIA 20%, Apple 4.5%, Broadcom 4.5%. You can see that from the early part of July, there was a 19.9% sell-off. We broke all of the moving averages. As you know, we got stopped out of our NVIDIA going through the process. Now, there has been a sharp rally. but I want to highlight it's only rallied about halfway back to the highs. And so relative strength continues to wane since January. And so we continue to have an underweight in the group. If you look at semiconductors as a group, this is the equally weighted semiconductor index. Again, relative strength actually has waned for the equally weighted index, trading better than only 55% of stocks. It was off 27% in that sell-off, so I was pleased that we had such a light weight. And the recovery has been less than 50% back to the old highs. So I continue to be pretty cautious on technology. We are not adding in this area. We find that there are other areas of the market that are a little bit more interesting. So things are going pretty well. From the beginning of the year, equally weighted S&P is up 9.9%. The MSCI All World ex-US is up 9.8%. The aggregate bond index up 3%. Our income portfolio, more focused on dividend growth, is up 17%. Very pleased with that versus fixed income or really any other income security that I can find. Equity portfolio is up 16.4%, and the global portfolio up 11.7% versus the MSCI up 9.8%. So things are going generally pretty well. Our turnover has been relatively low, and from a holdings perspective, things have been pretty consistent. Financials make up 23% of our total firm holdings. That's about twice the index weight in the S&P. Our energy weight is about 12%. That's a combination of pipelines and energy producers versus 4% for the S&P. Strong performing group. Industrial's been pretty steady around 11 or 12%, about a 50% overweight. Technology now only about a third of the index. So we're not too concerned about weakness in this area. Our stocks are actually holding in pretty well, the ones we have. Materials is about a 3 times weight of the index. We added about 2.5% this week to additional gold holdings. May not be a popular choice, but certainly they are performing. Healthcare is less than 50% of the index weight. Communication services less than 50% of the index weight. Consumer discretionary almost non-existent. We think this is the one area that is probably at risk of a consumer being squeezed by rates. So not a lot changing. We're continuing to reevaluate everything. And the one thing that we want to remember is that we're now into a liquidity cycle. The number one impact on asset prices is liquidity. When there is new liquidity coming into the market, it tends to be supportive of asset prices. We are through a liquidity contraction. And so we should have pretty solid runway in front of us as we move forward. When we look at risk indicators, credit spreads are still very low as to versus where they were in 22 and certainly where they were during COVID. This is telling you that bond investors are not terribly concerned with credit quality. We talked a little bit about VIX already, but I wanted to pinpoint this. This decline from 65 to 15 is the single fastest contraction in volatility on record. When you look at other periods where there were significant declines in volatility over 9 trading days since 1990, and you go out 1 year, 100% of the cases were positive, an average return of 14%. 2 years out, 3 years out, 4 years out, and 5 years out, 100% of the cases positive. So we think we're not in a bad spot. The S&P is up 1% on the month. We should be into a relatively lower volatility run-up in prices. And we think there's a lot of people who are sitting on the sidelines, worrying about elections, worrying about war in the Ukraine, worrying about problems in the Middle East. But remember, there's always problems to worry about. And the moment that there isn't something to worry about, you better worry because there's probably something you're not considering. If things get more difficult and breadth starts to change, we'll get more defensive. Right now, we're about 4% cash. We are looking at things to do with that cash. And should our breadth indicators continue to improve, we'll put that money to work. So it's the middle of August. Hopefully you guys are enjoying some golf, some time outside, because we know at some point winter is coming. We appreciate you tuning in. Let me just take a look and see if we have any questions that I can answer here. Okay, couple of questions. Steve, gold has performed nicely and some gold miners too. Have you any idea why smaller companies, more speculative companies, haven't chimed in? You know, look, this is very similar to the way any sector works. When a sector's been out of favor, the largest and highest quality companies rally first. And as people gain confidence, they tend to trade down in quality and take on more risk. And that's likely to be the case. Gold went through a bear market for over a decade, and every rally failed. So you can understand why lots of people think it's a terrible business and it's a difficult place to make money. But in the course of a career, you get 2 or 3 opportunities where there's a real cycle. And I would tell you that I think this is one of them. And we are starting to see some of the intermediate sized companies participate nicely. And I think there's probably, a long running room in front of us. But remember, there's going to be corrections, there's going to be pullbacks. So don't sacrifice quality. You can buy some smaller companies, but make sure they have quality assets, quality management, and strong financing. Dave, are you feeling as bullish on insurance companies as you are on financials overall? Yes, we are. And just to highlight, in our top 10 positions, Fairfax Financial is there. Progressive is there. They're both property and casualty. Our largest life insurance company would be Manulife. But we also own Reinsurance Corp of America. And I know we own more, but I can't think of them off the top of my head. Sebastian asks, would you say we are out of the woods as far as the correction goes, with the advanced decline on the S&P making a new high? I do think that the majority of the weakness has been seen. I wouldn't say that it's impossible that we could get some kind of a pullback. We have rallied 8 days straight. I don't think that tech is out of the woods. The fact that semiconductors really only have recouped about a third of what they gave up tells me that maybe there's some rotation taking place. So you got to pick your spots. But for the key sectors that we're focused on, I feel pretty good. This liquidity is going to work its way through the system. And if some of our shorter term indicators show some weakness, we'll do something about it. But as it is right now, I'm pretty pleased with the way that volatility's come in and money's getting put back to work. I think that is all of the questions. Oh, one more. My friend Alejandro, with which precious metals companies do you like most to be positioned on the long-term bull market? So our biggest position is Agnico Eagle, and it's because it's a multi-asset company. They have had a history of being able to grow, and they have pretty long life assets. It's well financed, and it's well known by institutional money managers. I think that Agnico stands out. Kinross is another holding that we have, K on both in Toronto and KGC in New York. Alamos, we think, is an interesting intermediate. But, Wheaton Precious Metals looks pretty good. Eldorado looks pretty good. There's a number of them. But this sector is not well owned and it's not well liked. And, I cringe a little bit even talking about it because I don't want to sound like a gold bug, but there is a time and a place. And I think these companies can generate a lot of cash flow. If gold goes to $2,700 or $3,000, they're going to be making a lot of money. So prices will be a lot higher. And with that, I'm going to end the call for today. And I look forward to seeing everybody next week. Have a great week.